Day trading can feel like a chaotic ocean of flashing numbers and fast-moving charts. Many new traders jump in, guided by hope and guesswork, and are quickly washed away by the unpredictable tides of the market. But successful trading is not about guessing. It is a business built on a foundation of a clear, repeatable process. It is about trading a plan, not your emotions. Today we will walk through a simple yet powerful trading plan. We will use 3 well-known stocks as our examples to make the concepts clear: NVIDIA, NVDA, a leader in technology; Plug Power, Plug, a player in the alternative energy space; Intel, INTC, a long-standing semiconductor giant. Following these steps consistently is the first real move toward professional trading. This essay is your map. It is designed to guide you away from the pitfalls of impulsive decisions and toward the steady ground of structured trading. Imagine a clean trading desk with multiple monitors showing stock charts for NVDA, Plug, and INTC before the market opens. The trading day does not begin at the 9:30 a.m. Eastern Time opening bell. For the professional trader, the most critical work is done in the quiet hour before the market opens. This is the time for preparation, not prediction. Your first task is to scan the pre-market activity. Look at stocks that are making significant moves and, most importantly, have unusually high volume. High pre-market volume is a sign of institutional interest. It tells you that big players are positioning themselves in a stock. This is where you will find the best opportunities for the day. If NVDA is up 5% on millions of shares traded before the open, it immediately becomes a stock to watch closely. Once you have identified your watch list of stocks, perhaps NVDA, Plug, INTC, your next step is to map out the battlefield. You must identify the key price levels on their charts. These are your technical landmarks. Mark the pre-market high, mark the pre-market low. Then, zoom out on the daily chart. Mark any significant support levels from previous days. Mark any significant resistance levels from previous days. These are the prices where the stock has previously reversed direction. The opening bell rings at 9:30 a.m. The market explodes with activity. The opening drive is famously volatile and treacherous. Prices can whip back and forth violently. The disciplined trader does not jump in immediately. Your job in the first 5 to 15 minutes is to watch and wait. Let the market show its hand. The plan you made in the pre-market is your guide. Wait for the market to confirm your thesis. Patience is a form of risk management. It prevents you from getting caught in the initial unpredictable noise. Confirmation comes in several forms. Price volume, you are looking for a clear breakout. A breakout occurs when price moves decisively above a key resistance level or below a key support level that you identified in your pre-market analysis. But price movement alone is not enough. This breakout must be accompanied by a significant surge in volume. High volume confirms that there is conviction behind the move. A breakout on low volume is a warning sign. It is weak and more likely to fail. Another key confirmation tool is the volume-weighted average price, or VWAP. The VWAP is a dynamic line that represents the average price weighted by volume throughout the day for traders looking to buy. A powerful confirmation is to see price break above resistance and then hold firmly above the VWAP line. This indicates buyers are in control and the average participant is in profit on the day. For example, if INTC breaks its pre-market high, pulls back slightly, but finds support at the VWAP line before moving higher again. That is a very strong signal to consider an entry. Let the market prove the direction before you commit your capital. For instance, you might see Plug approach its pre-market high right at the open instead of buying it instantly. You wait. You watch to see if it can break through that level. Then you watch to see if it can hold above it. You check that the volume is increasing on the breakout candle. You check that the price is above VWAP. Only when all of these conditions are met does your plan signal that it is time to act. Once you have received confirmation from the market, it is time to execute your trade. But before you click the buy or sell button, you must define 3 critical prices with absolute clarity. These are the 3 pillars of every trade: your entry price, your stop-loss price, your profit target price. Entering a trade without knowing all 3 of these is like setting sail without a rudder or a destination. You are simply adrift, at the mercy of the market's currents. A professional trader never enters a trade without first defining their complete plan for managing it. This is non-negotiable. Your entry price is where you will initiate the position. For a breakout trade, a common entry strategy is to place your buy order just above the breakout level once it has been confirmed. For our NVDA example, if the pre-market high was $1,250 and it broke through on high volume, you might enter at $1,250.50. Your stop loss is the most important price of the three. This is your predefined exit point if the trade moves against you. It is your protection. For a long trade, the stop loss is typically placed below the breakout level, below the low of the breakout candle. If NVDA broke out from $1,250, your stop loss might be at $1,248. This defines your exact risk on the trade. The third pillar is your profit target. This is where you plan to take your profits and exit the trade.